Hi. So as you can see, chapter 3 is is going to be about what's called double entry bookkeeping. This is the continuation of our understanding of how bookkeeping is recording transactions. And the first thing we're going to learn here is some new language. Debits and credits. It's interesting. I took my first accounting course at Valley College in the San Fernando Valley. And I was taking it at night. And the instructor said, in explaining what debits and credits, he said, debits are to the window, credits are to the wall. And I never realized until later on how silly that was to say. Because if debits are to the window and credits are to the wall, what happens when I'm in a room that's in the reverse? So what we're going to understand here is debits are on the left of what we call the T account, and credits are on the right side. Debit, credit. What do they mean? I have no idea. I just remember it. So debits on the left, credits on the right in this T account. Now, another way of looking at the debits and credits is looking at the accounting equation. Assets equals liabilities plus stockholders' equity. We've looked at that before. We've been talking about it for 2 weeks. Now, the key here is understanding what is the normal balance of these categories. And what normal balance means is what will increase these categories. So, for example, if I get more cash, that's an increase to my assets. I'm going to debit the cash account because assets have a normal debit balance. So debits will increase them, credits will decrease them. On the other side, for liabilities and stockholders' equity, they are credit balance categories, which means that a credit will increase them, a debit will decrease them. Now, understand from the accounting equation again, remember, assets are things that the company owns. That's property, that's investment in things that the company is going to use to create revenue. Excuse me. Liabilities are things that the company owes. Those are debts. And then, of course, stockholders' equity is the difference between the two. Subtract the liabilities from the assets, and you get stockholders' equity. That's what the stockholders pretty much their claim in the company is. Now, when reading transactions, it's important to understand that you read it, understand it completely, and then we're going to record it. The understanding of the transaction is key here. So first, determine how an event affects each element of the accounting equation. Specifically, does the event cause the assets, liabilities, or stockholders' equity to increase or decrease, or remain unaffected? That would be an NA in our horizontal model. Step 2, now you're going to use the credit and debit concepts that we just talked about. What are the normal balances? And that will determine where you're going to put what you found here in analyzing the event. And number 3, identify the specific asset, liability, or stockholders' equity accounts affected by the event and record the debits and credits. So remember, under each category, asset, liability, stockholders' equity, we keep accounts, titles, so that we can subdivide what's going into those categories into appropriate titles. So it makes more sense. And you're going to see that more clearly when we go forward. So first, you've got year 2 accounting events for a small business. Collins Brokerage. Now remember, the accounts from the balance sheet are permanent accounts. So they carry forward from one year to the next. So for year 2, we now have to bring forward the balances in the permanent accounts. In this case, we've got a $5,000 cash balance, a common stock balance of $4,000 and retained earnings of $1,000. Now, for purposes of recording them to bring them forward, first of all, we've got $5,000 in assets, cash, $5,000 in stockholders' equity. So our accounting equation balances. Now, since this is cash, this will be a $5,000 debit balance. Why debit? Cash is an asset. Assets have a normal debit balance. Common stock and retained earnings, these will be credit balances for $4,000 and $1,000 because stockholders' equity has normal credit balance. It carries forward to all the accounts. January 1st, year 2, Collins acquired $25,000 cash from the issue of common stock. We've looked at this transaction like probably 100 times since the beginning of the semester already. So we got cash, we sold stock. Well, cash is an asset, so cash is going to get debited 25 grand. Common stock is part of stockholders' equity. That will be credited 25 grand. And of course, we've got a financing activity on the statement of cash flows. So remember, we're always going to have a debit and a credit for each transaction. And the debits and credits must balance. In this case, they do, $25,000 apiece. Purchased $850 of supplies on account. Now we remember on account means we didn't pay for it yet, but we received the supplies. So supplies is an asset. We debit supplies for $850. On account means it goes into accounts payable, a liability. Liabilities have a normal credit balance. We credit liabilities for $850. Number 3, collected $1,800 cash as an advance to provide future services over a 1-year period. Now remember, we talked about this in chapter 2. When we get paid up front, but we haven't done any work yet, that becomes a liability called unearned revenue. Again, liabilities have a normal credit balance, so we credit unearned revenue for $1,800, and we were paid cash, so again, the asset cash goes up by $1,800. During year 2, Collins provided $15,760 of services on account. Okay, so here is a case where we provided services, so we need to recognize or earn the revenue, but we didn't get paid yet. So when we don't get paid, that's an asset called accounts receivable. I'm waiting to receive the cash. So we're going to debit accounts receivable for the $15,760 that we earned, and we're going to credit service revenue to recognize the revenue that we earned since we provided the services. During year 2, Collins paid $26,000 cash to purchase land. This is that land for cash thing, the asset exchange that we've talked about quite a bit. So the asset cash is going to get credited because it's going down, and the asset land gets debited because it's going up. So credit cash, debit land, 26 grand. Paid $1,200 cash for a 1-year insurance policy with coverage starting August 1st, year 2. All right, we're paying cash up front for insurance. So this is going to be an asset called prepaid insurance. We're going to debit that asset for $1,200, and we paid cash, so we're going to credit cash for $1,200. Another asset exchange. We're exchanging cash for prepaid insurance. Collected $13,400 cash from accounts receivable. All right, that means that some of those invoices that we had in accounts receivable were paid. So we're going to debit cash for the $13,400 that we received, and we're going to credit accounts receivable for $13,400 asset exchange again. Accounts receivable gets the credit because it's going down, because we got paid. Paid $9,500 cash for salaries expense. Okay, we have to recognize an expense. So that means a debit to salary expense. Revenue is a credit balance account. Salaries expense, all expenses actually, are debit balance accounts. So we're debiting salaries expense and crediting cash to pay for salaries. And of course, on the statement of cash flows, we have an outflow of $9,500 for an operating activity. Paid an $800 cash dividend. Well, we remember that we keep our profits in the retained earnings account. And a dividend is a partial distribution of those profits. So we're going to debit retained earnings and credit cash. So obviously it's a cash dividend, we're paying it out. So debit dividends, credit cash. Paid $850 cash to settle accounts payable. So these are bills for vendors that we haven't paid yet. We received the goods or services, but they weren't paid for. Now we're paying them. So again, we're paying cash. So cash gets a credit of $850 because it's going down. And the liability accounts payable gets a debit for $850 because it's going down. During year 2, Collins recognized $1,900 of other operating expenses on account. So again, these are expenses that we've incurred, so we need to recognize the expense, but we haven't paid them yet. They're on account. So the on account portion is a credit to accounts payable. Remember, accounts payable is a liability which has a normal credit balance. So we're increasing the liability. We credit it for $1,900. And we recognize the expense with a debit of $1,900 to other operating expenses. Now we have adjustments. Anybody remember what adjustments are? Remember, adjustments are done to accounts that include revenue or expenses that we need to recognize for the year, but we haven't yet. In this case, we're earning $1,500 of the unearned revenue. How did we get that? Well, we originally were paid $1,800, divided by 12 is $150 a month. 10 months have gone by since we signed the contract. So we've got $1,500 of the revenue to earn. Earning the revenue means to debit the liability, unearned revenue. That's going to go down. And we're moving that $1,500 over to service revenue. So we're crediting revenue and debiting service revenue. And this is a claims exchange. Remember, these are both claims categories. As of December 31st, Collins had $800 of accrued salary expenses that will be paid in year 3. Remember, accrued salary expenses specifically, means that we had salary expense in 1 year that's not going to be paid until the next year. So we need to recognize the expense in year 2, even though it's only going to be paid in year 3. We recognize salary expense by debiting salary expense $800, and we accrue it in the salaries payable account. We owe it. It's something we eventually will have to pay. So it's a credit of $800 to salaries payable. As of December 31st, year 2, Collins had used $500 of the $1,200 of insurance coverage. Okay, how did we figure that one out? Well, we paid $1,200 for a year. That means we're recognizing $100 a month of insurance expense. And we had 5 months go by. So 100 times 5 gives us $500 of insurance coverage that expired. So we need to recognize that expense. We debit insurance expense for $500, and we credit the asset prepaid insurance. We need to reduce that to where it actually is. So we have a $700 debit balance in prepaid insurance after we make this adjustment. And adjustment number 4 is the supplies account. So we do a physical count, and it tells us we've got $125 of unused supplies that are available for the future use, which means that since we started, we started with $850 of supplies. That's what we bought. We have 125 left. That leaves us with an expense of $725 for supplies. So supplies expense gets debited, and supplies, the asset, gets credited. That reduces it down to the current balance of $125. Now, accountants initially record data from source documents into journals. The source document could be an invoice from a vendor. It could be an invoice that was received by a customer. It could be anything, a document that gives us information related to the transaction. Provided we're going to look at how we do this journal entry, which is what it's called, providing services for $1,000 cash on August 1st. So for the journal entry, we have to put in a date, so August 1st. The account title, the debit always goes first. The debit here is cash because we got paid. So we're going to debit cash for $1,000. Excuse me. And the credit will go to service revenue. We provided services. So this is a journal entry. This is the way we record the transactions. And that will do it for Chapter 2. Please stay in touch and send any of your questions to me if you have.